Hi everyone, joining us today off the back of the Reserve Bank's July meeting, CommBank's Chief Economist, Stephen Halmarick. Stephen, thanks for joining us.
My pleasure, thank you.
Well, as expected, no surprises, the Reserve Bank has increased the cash rate up to 1.35%, 50 basis points. What are your thoughts about that?
Well, as you said, no surprise. We had expected that 50 basis point move, as did the rest of the market. So the reaction in markets was pretty muted. But that's 3 rate hikes in a row now, so May, June, July, 125 basis points in total. So that's relatively aggressive from the Reserve Bank. But they made the point that this is a global trend. So global inflation is rising, global monetary policy needs to be tightened to respond to that, and Australia is part of that. And they also made the point that this is really about normalising monetary policy, normalising interest rates after those super low rates were put in place in the middle of the COVID pandemic.
What about Australian business? What impact will it have on Australian business?
Well, the cost of borrowing will rise after the rate hikes we've just seen in the last few months and the expectation of some more rate hikes to come. But I think businesses need to put that in the context of an economy that's been doing really well, a strong labour market, strong consumer spending. We're seeing signs of an increase in investment as well. So for businesses, that does mean higher borrowing costs, but again, in the background of an economy that's in pretty good shape.
Obviously, lots of interest on the impact on home loans. What about home loans and spending?
Well, so mortgage rates will rise as well. They've been going up again with the cash rate rise and a bit more to come in the months ahead. So we do think that house price growth will continue to moderate. So we've seen house prices start to fall. We expect to see house prices down about 6% this year, down another 8% next year. Consumer spending likely to be softer as well. Again, from a very strong position. Up until May, consumer spending was really solid. But as people have to spend more of their income servicing their mortgage, it likely means less spending on lots of other things. So we do think both the housing market and the consumer spending side will be softer in the months ahead.
Realistically, tougher times. What would you say to consumers who might have concerns?
Well, that's right. I think the cost of living is rising, higher inflation and higher interest rates are going to be part of that. So that's going to make managing the household balance sheet a little bit tougher. But I think we need to think about that in the context of the economy that's been quite strong, particularly the labour market. So the unemployment rate is at 3.9% in May. That's the lowest since 1974. So that's really helping households generate some more income to offset these higher costs. But definitely we're now going to go through a period where the economy is going to be a little bit tougher, but that strong labour market, I think, means underlying the economy is in pretty good shape.
Good to get your thoughts. Stephen, thanks for your time.
My pleasure.